VONG's 126% crushes SCHX's 87%, but you paid for it with an 8-point deeper crash and over a year to recover. Now let's shift gears and look at VONG absolutely crushed SCHX by 39 percentage points over 3 years. That's a massive win for growth investors here. But here's where it gets interesting. Over 5 years, VONG's 106% return shows growth stocks winning big. Patience pays off despite the bumpy ride. Let's zoom in on this. SCHX delivered a solid 93% return over 5 years, trailing by just 13 percentage points. Remarkably close performance long-term. In plain English, VONG's the race car here. Higher returns, but you'll feel every sharp turn. SCHX is your steady highway cruise. Safer, but slower. Both get you there, just different routes. Here's where the story takes a turn. Perfect parity here. Both delivered exactly 18% returns over 12 months. Growth's usual advantage completely disappeared in this trailing year period. Let's break this down further. Raw returns alone won't cut it. We've got to factor in the risk each fund swallowed to earn those gains. A 1.3 Sharpe ratio means you're getting solid returns for the risk you're taking. That's pretty attractive for growth investors. Now for the real question. SCHX nearly matched the leader with a 1.2 Sharpe ratio. The risk-adjusted performance gap between these funds was basically negligible. In plain English, think of Sharpe ratio as your investment report card. VONG and SCHX both scored solid B+, meaning they're delivering strong returns without taking reckless risks. Pretty impressive marks here. Here's where things get revealing. After 5 years, both funds delivered identical risk-adjusted returns. 0.6 Sharpe ratios prove they're neck and neck for long-term performance. Now let's put this in perspective. Sortino ratio focuses on what really matters to investors. Protecting your money when things go south, not punishing upside gains. But wait, there's more to this story. VONG's 1.8 Sortino ratio shows it's delivering solid returns while keeping those painful downside losses well under control. In plain English, the Sortino ratio is like a swimming pool, where we only care about downside risk, not upside gains. VONG managed its downward dips better than most growth funds, showing impressive risk control. Let's take a closer look. SCHX's 1.6 Sortino ratio shows solid downside protection, though it slightly trails VONG's performance over 3 years. Now here's where it gets tricky. Maximum drawdown measures your worst-case scenario. It's the peak-to-trough loss you'll endure when everything crashes hard. But that's not the whole picture. VONG's 33% drawdown shows growth investing's painful reality. Watching a third of your money vanish takes serious mental fortitude. Let's see how this plays out. SCHX's 25% drop was manageable. The Stability Fund preserved 8 more percentage points when markets crashed hardest. In plain English, maximum drawdown is like watching a building crumble during an earthquake. VONG lost more floors, but both stayed standing. Can you emotionally handle watching those floors disappear? That's the real test. Now let's connect the dots. Recovery time isn't just about patience, it's about opportunity cost. Every month you're underwater is money you're not making somewhere else. But hold on a second. Over a year watching your money crawl back to zero, that's the patience you'll need if VONG tanks again. Let's unpack this a bit. All right, pause here. Who's your pick? VONG or SCHX? Drop your vote below. Here's the key takeaway. SCHX bounced back in 427 days. Surprisingly slow for a fund with a smaller drawdown than VONG's deeper drop. In plain English, here's the fascinating part. Whether you're down 10% or down 40%, you're still looking at about 14 months to heal. Like a marathon runner's injury, recovery time doesn't scale linearly with severity. Now let's shift gears and look at volatility's the roller coaster factor. Higher standard deviation means you're in for bigger thrills and scarier drops along the way. Let's get into the weeds here. VONG's 21% volatility means you're signing up for wild swings. That's the price of chasing growth here. Now let's shift gears and look at SCHX's 17% volatility means smoother sailing. The Stability Fund cuts turbulence by 4 percentage points for those preferring calmer waters. In plain English, VONG's the wild roller coaster with steep drops and thrilling peaks, while SCHX gives you gentler hills. Both get you where you're going, just depends on how much turbulence you can handle. Let's zoom in on this. Beta above 1 means you're in for a wilder ride. Bigger gains when markets climb, steeper drops when they fall. But here's where it gets interesting. VONG's 1.2 beta means it amplifies market moves by 20%. So when the S&P drops 10%, expect VONG to fall 12%. Here's where the story takes a turn. SCHX's beta of exactly 1.0 means it moves perfectly with the market. No extra risk, no extra reward amplification. In plain English, beta's like an amplifier knob on your stereo. VONG cranks market moves up 20% louder, while SCHX just plays them at their original volume. Higher beta means wilder swings both ways. Sector allocation's the real driver here. Tech concentration separates the winners chasing growth from those playing it safe with stability. Now for the real question, VONG's putting over half its chips on technology, 53% in one sector. That's a concentrated bet that'll amplify tech's moves. Let's dig into the details. SCHX keeps tech at 35%. Not too heavy, not too light. That balanced approach spreads your risk across the whole market. In plain English, VONG's got 53% of its eggs in tech. That's serious concentration. SCHX spreads the risk much wider. Higher concentration means bigger wins when tech soars, but brutal losses when it crashes. Now let's put this in perspective. VONG delivered higher returns at 126% versus SCHX's 87%, but you paid for it with more volatility and a deeper drawdown. Similar Sharpe ratios mean the risk-adjusted performance was nearly identical. But wait, there's more to this story. Higher PE ratios mean you're paying more for each dollar of earnings, basically betting that future growth justifies today's premium price tag. Here's the thing though, growth investors are paying nearly 30 times earnings here. That's the premium you'll pay betting on VONG's future profits. Let's take a closer look. SCHX trades at 22 times earnings, but there's a stability fund out there offering better value with lower expectations baked in. In plain English, think of the PE ratio as couch change. VONG makes you pay $29 to reach those coins, while SCHX only charges $22. Same coins, same future value, but you're paying different entry prices up front. But that's not the whole picture. More stocks means one blow-up won't wreck you, but too much diversification can water down your best winner's impact. Let's see how this plays out. SCHX spreads your money across 753 companies. That's serious diversification protecting you from any single stock blowing up your portfolio. Here's what really matters. VONG's concentrated in just 394 stocks. It's trading broader diversification for a sharper growth focus, accepting the concentration risk that comes with it. In plain English, SCHX spreads risk across 753 holdings, while VONG concentrates on just 394. Like juggling more balls versus being pickier about which ones you toss. Different approaches to managing diversification. Here's where things get revealing. Mega cap weight reveals a fund strategy. Heavier on giants means stability. Lighter means chasing growth with smaller, riskier bets. Let's unpack this a bit. VONG anchors heavily in mega caps at 64%. You're getting the most stable, largest companies driving this growth fund. Here's the key takeaway. SCHX puts 43% in mega caps, with the rest spread across mid-cap and smaller companies for broader market exposure. In plain English, VONG's built like a construction rising, stacking 64% of its weight on mega-cap giants, while SCHX spreads out with just 43%. You're getting more stability, but less room to pivot when markets shift. But there's a catch. Doubling your stock count doesn't double your returns. SCHX proves there's a point where adding more holdings just stops mattering. Let's get into the weeds here. VONG's concentrated 394 holdings delivered better risk-adjusted returns than SCHX's 753 stocks. Sometimes less really is more here. Now let's connect the dots. Fewer stocks means bigger swings. VONG's 21% volatility versus SCHX 17% shows how diversification directly dampens the ride. In plain English, here's the diversification seesaw in action. SCHX brings stability through broad holdings, while VONG swings for higher returns with concentration. Same playground, opposite strategies tipping different ways. Let's just zoom in on this. Fees compound quietly over time, turning small percentage differences into surprisingly large dollar amounts that you'll never get back. But wait, there's more to this story. VONG's expense ratio is incredibly low at just 7 basis points. You're paying only $7 per 10,000 invested annually. Here's where the story takes a turn. SCHX wins the cost battle at just 0.03%. That's 4 basis points cheaper than VONG, saving you real money over time. In plain English, VONG's 7 cents per $100 versus SCHX's 3 cents is basically couch change territory. Both are dirt cheap, but SCHX clearly wins the cost battle here. On 100 grand, that $40 fee gap shrinks compared to what each fund's actual returns will deliver over time. Now for the real question, VONG's 126% return crushes SCHX's 87% over 3 years. That 39-point outperformance dwarfs any expense ratio difference you'll find. Let's dig into the details. VONG's 39 points extra return comes at a price. 8 points deeper drawdown and 4 points higher volatility versus SCHX. In plain English, VONG's concentrated approach chases bigger wins but carries more risk, while SCHX's diversification protects you from major losses. Your investment timeline is what determines which egg basket strategy actually makes sense for your money. Now let's put this in perspective. Similar recovery times despite different crash depths shows that growth premiums don't necessarily speed up your comeback from major losses. But wait, there's more to this story. Nearly identical Sharpe ratios reveal the truth. VONG's higher returns simply came from taking more risk, not superior efficiency. Here's the thing though. VONG's 53% tech allocation versus SCHX's 35%. That massive 18-point gap explains why VONG delivered higher returns, but also bigger swings. So which one's for you? VONG if you're chasing maximum growth and can handle big crashes, SCHX for smoother sailing. In plain English, so here's your choice. VONG's the thrilling mountain highway with breathtaking highs and scary drops, while SCHX is your steady interstate cruise. Pick the road trip that matches your tolerance for wild rides. But that's not the whole picture. All right, you've been warned. Do your homework before investing and don't blame me later. Let's see how this plays out. That's a wrap on this ETF showdown. Hit subscribe if you want more weekly comparisons to sharpen your investing game.